What is a IRA rollover anyway? Are you working for a company and deciding to quit? You've been let go? Or whatever the case is? Are you about to change jobs or just leave the workforce? An individual retirement account rollover enables you to move retirement assets from a qualified plan such as a 401k, profit sharing plan, defined benefit plan, cash balance plan, or any of the above to an IRA account without subjecting them to penalties or taxation. An IRA rollover allows you to preserve the tax-deferred earnings of your savings and also enables you to personally manage your retirement plan assets. If you cash out, generally speaking, you have to pay taxes on the amount you withdraw from the account. Now, and sometimes, by the way, you have an additional 10% penalty on top of that, depending upon the circumstances. Being conceptual, if you withdraw $100,000 from a 401k plan, and let's say you're a 20% tax bracket person, just pretending for simplicity purposes, you will owe Uncle Sam $20,000. If you're below 59 and a half years of age, you will owe an additional 10%, as they call it, excise penalty. Now, let's say you decide to roll over the amount into a qualified plan. This would be called a rollover. There are two types of rollovers, direct and regular. Through a direct rollover, all assets are transferred directly from a qualified plan to a traditional IRA with no immediate tax liability. Through a regular rollover, or sometimes called a distribution or withdrawal from your plan, your plan administrator is required to withhold 20% of any distribution you elect to receive toward payment for income taxes. To avoid current taxes or other potential penalties, you must reinvest the full value of that distribution into an IRA or qualified plan within 60 days of receiving the money. If you have stock or your employer in a qualified plan, you may also want to consider taking a distribution of that stock, then rolling over the assets into a qualified plan. Employer stock in a qualified plan, it's entitled to certain tax advantages that other qualified plan assets are not. Be sure to consult your financial services professional before you take a distribution or do a rollover. Now, how can you avoid the 20% tax reduction? Listen up. Number one, having the money rolled over into an individual retirement account, IRA, by the employer, leaving the money in the employer account if they allow for that, depending. Or two, arranging an installment payment for the life expectancy of the lump sum of the recipient, plus the life expectancy of his or her spouse, depending on the situation, which avoids the 10% penalty on early withdrawals, but not current income taxation. Number three, transferring the lump sum directly into an employer's plan, such as a 401k plan, profit sharing plan, defined benefit plan, etc. Usually the safest approach may be number one. It really depends upon the circumstance. Now, when the employer rolls the money over into an IRA, it remains available for withdrawal, quote, should the need arise, by the way, or to roll into another employer's plan at a later date. That option also leaves you in charge of actively managing the IRA proceeds in savings and investment vehicles that are consistent with your goals and specific objectives. Now, bear in mind, you should always consult with a qualified tax professional to determine the tax consequences with the various lump sum options. If you have any questions, we at vastsolutionsgroup.com can help you in kind of navigating the waters as it relates to rollovers, distributions, etc. Or give us a call, 888-808-8278. It's been good talking to you. Once again, Kenner French with Vast Voices, the media arm for vastsolutionsgroup.com.